speaker is Dan Fuss, and let me give a little bit of a background on Dan. He has 60 years of experience in the investment industry, and he's been with Loomis Sayles Company since 1976. He is vice chairman of the firm's board of directors and manages the firm's flagship, Loomis Sayles Bond Fund, which won the 2009 Morningstar Fund Manager of the Year award in a fixed income category. In addition to the Loomis Sayles Investment Grade Bond Fund, Investment Grade Fixed Income, Strategic Income, Fixed Income, Institutional High Income, and Global Allocation Funds. In 2012, Dan received both the Institutional Investor Money Management Lifetime Achievement Award and the Liberal Excellence in Investing Award. In 2013, Dan received the CFA Society of Milwaukee Lifetime Achievement Award. In 2000, he was named to the Fixed Income Analysts Society's Hall of Fame in recognition of his contributions and lifetime achievements towards the advancement of the analysis of fixed income securities and portfolios. He has twice been president of CFA Society Boston. He has BS and MBA from Marquette University, and he also served in the U.S. Navy from 1955 to 1958 and held the rank of lieutenant. Dan?
Thank you for having me. If I talk quick, well, I better not try it. The room goes a little too far back, and I have a tendency to whisper at times. Can you hear me back in the corner? Can you hear me in that corner? Down all the way in back? I'm sorry. I can't begin to top our previous speaker. That wind-up was wonderful. Let me say in advance, this is a somewhat more than somewhat serious discussion. We're talking about the bond market, we're talking about the financial markets, and we're talking in reference to a much broader world than would have been the case, say, 10 years ago. There's hope at the end. Hope is not an investment strategy, but there is hope. And it goes like this. We'll talk about peace or lack thereof, people, politics, both within nations and on a geopolitical basis, a prognosis on the economy, and the markets themselves, the trap that the central banks are in, and then wrap it up. And let's start with peace or lack thereof. You're going to have to forgive me in advance. I have a cramp in my right leg, so I'm going to walk around a little bit. The peace or lack thereof is a very serious problem. It's very timely, and it's not trending very well. And when you look at the history of the world as we know it, as is reported to us, and I'm one who was a young boy when World War II started, so I've seen this sort of thing. You have to be careful when you see certain situations. We'll cover them more in the geopolitical. But right now, the trends are not favorable. After a period of quite a long period, essentially you can say from when the wall came down until recent years, we were investing money in a period of time when the geopolitical or the political exterior was not scary. We still had various things going on around the world, but the whole nation was not committed to it. Defense spending was easing. In total, perhaps not, but as a percent, yes, particularly in places like Western Europe. So that's the setting. The trend is from peace a little bit towards lack thereof. with pockets around the world where it really is lack thereof. How about people? Well, several trends are noticeable in people. First of all, within some parts of the world, the population is aging. For example, I'm still here. Statistically, I'm not, but I am. And you're suffering through this tonight, so you can verify that. And the people, as is oftentimes true in the world, are moving. And normally not because they want to just go to San Diego for the winter. It's that they're moving out of stress. Sometimes it's peace or lack thereof. When you look at some of the people movements in the Middle East, Africa, and sometimes it's climate. Now, I should pause for just a minute right here and say that from an investment portfolio management viewpoint, we're looking at three things. We're looking at the here and now, what's happening right now in the economy, the markets, etc. What's the Fed up to? That kind of stuff. The day-to-day. But right tied up against that is the peace or lack thereof, is the geopolitical setting, because it's changing rapidly, much more rapidly than you would have thought a few years ago. And the major problem that we do have to deal with, and is an enormous investment opportunity with sizable returns, is, well, what about climate? Because we're running out of time. Now, I know this is an arguable point, but even from some of the more conservative views in a very liberal area, MIT, they say, you know, the doubters don't exist anymore, so it's a matter of when. And it's within the lifetime now of my great-grandchildren, and I would say even perhaps the youngest of the grandchildren. So you have to pay attention to this thing. It's moving faster than we estimated. Okay, back to the people. We are aging, we are moving. The moving causes stress, a lot of stress, and it can cause stress within particular political units, nations. Look to Europe, look to the United States for that matter. Look to Central America, Mexico, trapped in between, and parts of Asia. And there's a large movement coming in some parts of Asia because of climate change. It's happening. This is not a forecast. It's happening. It's causing stress. As you get to point 3 here, the individual nations, the politics within those, I think we're all reasonably familiar and have differing views. I've learned this in speaking with CFA societies in the other part of the country, although oftentimes when I ask what are the political sensitivities, they say, oh, Mr. Fuss, don't worry about it. This is CFA society. Oh, okay. And then I step right into it and discover that I've got a bunch of Yankee fans in my hands, and I'm from Boston. But it's getting serious within the nations of the more developed countries, developed in a political sense. If you look, let's skip the U.S. for a minute and go to Europe and look what's happening in the political cohesion in the largest countries in Europe, is that you had this center left, center right cohesion that somehow or another had been able to govern for quite a long time successfully and make some efforts towards bringing the European Union closer together, expanding it, yes. Bringing it closer together was more difficult. It was made easy because they didn't have to carry the heavy defense burdens they had as a percent GDP or GNP. But it was there, and it was successful. And now it's starting to pull apart for all sorts of reasons, many of which I truly don't understand. One of my grandsons keeps telling me, he says, well, Bumpa, that's because you're too old to understand this. We young people, he's 38. It's a part of that, but it's happening. And it's happening. 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 It's happening And quite frankly, it's not without precedent. When you go back in history, during peaceful times that run long enough, this does tend to happen. During less peaceful times, with stress at the border, people tend to pull together. So we have to keep that in mind. But it's there. Within our own country, the same thing. There is this pulling apart and division, and that presents problems. Geopolitically, it's very clear, to me at least, and I think to many others, who've given this a lot of serious thought. I should put as a footnote, I should have actually put it in the bio. I'm on a board over at the Belfer Center, at the Kennedy Center at Harvard, where you have all the retired and aspiring diplomats. So I get a lot of this stuff. The situation, the Thucydides trap situation is moving fast, where the rising power meets the established power. Talking with the author of the definitive book on it, Destined for War, came out 2 years ago, got far more press than anybody ever imagined. It was an academic study. He said, yeah, on the Thucydides line, that took 30 years. This is sort of, you're measuring it now in weeks. And that's a little different, because back with the ancient Greeks, it was swords and shields. Nowadays, it's nuclear-tipped missiles, so you have to take it seriously. There's an assumption that's probably true, but it's quite an assumption to depend on, that it will never come to that. So how is this contest, this all is impacting our markets, not in the future, but right now? We have a fair-sized client base in Asia, and along the periphery, mostly Japan, Thailand, some in China, and other parts of Asia, and we have 20 people over in Singapore. That area is changing very, very, very fast, very fast. And at the margin, there's an action, reaction, action, reaction, action, reaction. This week, that's coming. So you have to pay attention. Is it affecting the investment? It is certainly affecting the investment markets. On the fixed income side, the overnight from Asia has become a fixture of our morning meeting. It's present in the emerging markets. It's present to a lesser degree, but growing in high yield, and it's really a major factor in the investment grade markets. Every day, if there's a holiday, a major holiday, Chinese New Year, for example, it lessens. Or if there's just a one-day thing, it's much lighter, but it's there. And the money is coming through certain areas and funnels, and it's coming, part of it open above board, most of it's open above board. It's coming through financial institutions in Japan for a different reason, not because of China, U.S. They sell U.S. pay, single pay whole life, single premium whole life. That's a savings product. It's payable in U.S. dollars. The life insurance companies manage with U.S. investments behind it. Fortunately, they hire U.S. investment managers to do that. Then that's a very well-reserved business, and that's just a reflection of zero interest rates. Other money is coming through Taiwan and a few other spots, either directly or there's an unusual amount of activity coming through Brussels, which is primarily Chinese. And that's money that's leaving the area. And that's not good. We had a situation back in 1998 where money left the area because of the aftermath of a blow-up of a hedge fund and that spreading. And that really dampened the economies for a long period of time. Our central bank's very concerned about that. They talk about it. They don't want that again. And that was a function of a lot of things, and we have the makings of that right now. So that's not good. Now, what does this all mean for the economy? Well, the latest ratcheting up in some of these pressures, more in North America, but prior to that, prior to the Mexican tariff threat, we've had for the last few months a sense of some change. We have analysts that cover, all the, not all, but most of the major corporations. But we also have analysts that work on the loan side, and they're dealing with numbers 4 and 5 or 3 in the supply chain, mostly, industrial. And there you start to get the word that, well, they're not gonna ratchet up production this year. They're starting to cut their inventory slightly. That means that in some cases, go up to the Fox River Valley in Wisconsin, you can measure it coming down from Green Bay all the way down to Milwaukee. That's been really, really strong. They've been running short of people, they've been hiring, it's been really great, a recovery after a long, slow period. Now, it's starting to slow a little bit. The economic numbers are not slowing, but when you're number 4 or 5 in the supply chain, on down the line to the end producer, and the end producer brings down their inventory a couple percent. When you're number 4 or 5, you're cutting back maybe 15%, maybe 20%. How do they deal with it? Well, to get rid of the overtime, and that affects the income of the people in the area, but they're still doing much better than they were 6-7 years ago. They're not laying off. What happens if they have to reduce more? Now you will start to see it. And the people talking with Ford will say, well, yeah, we know they're doing some cutbacks. So measure down the supply chain, and when you get down to foreign, most of which is internal with Ford, you're going to find there's some larger cuts. You got to keep an eye on that. You get these ripples. You oftentimes figure, in fact, it was only weeks ago I was giving a speech like this in Barcelona, Spain. And at that time, this wasn't as visible as it is now. These things tend to move quickly. Once the end producer decides they're going to cut back slightly, you've got to look out when you're number 4 or 5 in line. That's happening again. It's happened before in this long economic run, but I keep an eye on it because it seems to be a little more pervasive out there. And it explains some of the things in the commodities markets. So that's that. Now, so the economy is strong based looking backwards. Looking forward on the economic numbers, there's some reason to be cautious. But now you bring in the political, geopolitical, and you say, oh geez, now we've got another problem. And it's all guesswork at this point. But our analysts and a lot of others have been studying this, and their instant reflex is to say, oh, you know what? And they've even convinced the chief economist that he's going back and redoing his numbers, saying, oops, we might have an event here. The tariffs, if they go through, short term, will have a negative impact. That part's fairly easy. Longer term, it is possible that this might interrupt the change in the supply chain. Go back in your memories to the floods in Thailand. I forget, 7-8 years ago, you had the flooding in the Gulf of Thailand. It got severe enough to come in and cut off the production in that swath of production that runs east of Bangkok and up around the top of the Gulf of Thailand. It messed up auto production. It messed up some areas of the technology area pretty badly, and it put the supply chain out of whack because of the weather. It was a benefit to certain people that produce back here in the U.S. that didn't have that vulnerability. So in response to that, people started to look at the supply chain and said, you know, we've got to get some of these areas out of there. But we might move that from Thailand over to Vietnam, and then gradually that started to migrate to us, to North America. If, for those of you who have a week ago's financial paper or some sort of listing, look down the list on the currencies for the strongest currency of any country of any size this year, and guess what? It was Mexico. Of all places. You say, that's crazy. No. Those currencies have all taken a bath. No, the Mexican currency was up about 3.5, 3.8 relative to the US dollar, which was in third place itself. That has been happening. That is now under threat. That's the kind of fear that creeps in. I'm really cheering you up a lot. It's a little hard to cheer up on this thing. These are things that are starting to enter into the consciousness, despite everything else going well. So now let's move over to the world's central banks, the major ones. They're sitting there looking at this stuff, and they say, you know, here in the U.S., let's face it, we've had a strong economy. Our mandate is keep the banking system running, fight inflation, and promote employment. Okay, that's a domestic mandate, but we've accommodated over the years. We've learned back over 20 years ago that we're also being the world's central reserve currency, major reserve currency, that we've got to keep the rest of the world in mind. Now, it's not in our exact mandate, and our mandate happened to be drawn up by the Congress. We report to Congress. The president has a heavy hand by appointing members of the board, but the rest of it is left to the regional banks, the presidents. So it's a balance. It's a well sought out thing. It's a political compromise when you think about it. Why do you have two of the 13 branches in the state of Missouri? Well, that was a compromise. And don't take that from me. That was taught to me by Bill Martin, whose father was part of that. That's the setting. The Fed's looking at this and they're saying, okay, the U.S. economy on the numbers is strong. However, let's take our time because there are some signs of slowdown. Fourth quarter in the markets last year scared a lot of people. And you can debate whether or not they should have bumped rates a quarter at that time. But right now, for sure, is a good time to pause. They have to be careful when they discuss anything in the geopolitical range or political range, but they're a little more open here in the last few days by coming out and saying, well, you know, the trade talks are definitely a concern. We have to be a little more cautious. Well, they're pretty good at calling people in around the various parts of the country, the regional bank presidents are. They just call everybody in their district and employs any number of people and say, how are things? And so they don't share that with me. I doubt if they share it outside of anything other than their own private discussions. But they're starting, it seems, from what, loose interpretation of the last couple of talks in recent days, they're more aware of this now, and so the market says, oh good, now they're going to cut rates again. You get that type of rally. Underneath that, you do have some concerns on inflation. They'll keep it muddy like that until they see what happens on the political side, is my own feeling, and see how the economy and the markets react. They're trapped. We talk about Thucydides trapped with the geopolitics. The Fed's trapped. They have their mandate. It's a domestic mandate. the major influences on our domestic economy are external. And they're coming from the political realm. Nobody anticipated that. It doesn't say in the Federal Reserve Act, at least the last time I went through it, it doesn't say you have to be aware of the relationship with China. You ought to be, there may be a footnote somewhere in an old note about Russia. Or you ought to be aware of what's happening in Europe. You ought to be aware that in Europe, interest rates are much lower than here. You ought to, that's the number 2 reserve currency. You got to be aware that in Japan, the number 3 reserve currency rates are very low, basically 0. You got to be aware that the Bank of Japan is buying up the government debt in Japan, along with ETFs. You have that. And our London office once in a while says, well, okay, European Central Bank has a motto, if it moves, they buy it. And, in other words, they've been managing a difficult situation. My own badge for Hero of the Decade goes to Mario Draghi, who's managed to somehow or another manage through this whole period of time. And I have great sympathy for whoever succeeds him. And the Fed's looking at this. The Bank of England's looking at it and says, well, the rest of the world thinks they have a problem. Look at us. We'll see you another time. We've got our own problem. It is a problem that the central banks have had put in their lap, that the stress within the European Union is there. It's part of their job to help it, succeed or at least stay stable. Our central bank, the creature of Congress, has their mandate written out. They have their obligations written out. The way, William McChesney Martin explained it to me. I reported to him for a year. And right after he was chairman of the Fed. And he said, Dan, I've listened to what you said, and he was so gentle. He said, it's good theory, it's wrong. He said, the reality is the Fed is a very political institution. We fought hard for it, we've got our independence back, but that's a relative thing. You have to realize our obligation is to the United States. He was saying that in 1971. He didn't extend it beyond that, but he said that is our obligation, but we work within a political environment, and we have to succeed within that environment. And he was still using the term we. And that's true. So I think the central banks, the major ones, and I'm going to include, by the way, the Bank of China in that, because they're creeping into this. They've got their own area of concern. But it's not just within China. And these are good people working hard with the tools they have within the boundaries that are political. And they're dealing with a geopolitical confrontation. And let's spend one more minute on that. And that is, with all the publicity, it's still, I think, understated. And you can see it playing out now. The tariffs, the counter tariffs are ratcheting things up. But the pressures have been there for quite some time. If any of you read Naval Institute proceedings or get their daily bulletins, you'll be very aware of this, the kind of stress that the U.S. Navy is having in that area. And it's gotten together with the leadership of the Chinese Army, that the Navy's a branch of, to see if they can't just try to dampen some of these stress points to avoid what the accidents that could come from that. Our central bank is well aware of that. Now let's spend 1 minute on the markets themselves. The markets are surprisingly well functioning. The bond market, which used to be big and thick with a lot of market makers, and the size being large relative to the amount of outstanding bonds, is now much smaller. In absolute dollars, it's about the same, a little bit smaller than it was 11 years ago, not much. But the market is much, much bigger. The number of market makers has shrunk from, let's say, 28, 29 to 6. In this middle of the market function has essentially been partially outsourced to people who used to be at the major banks, who are now running private partnerships or other entities. They're oftentimes called hedge funds, and that's accurate with some, not all. And they're forming that middle of the market there, and they're performing that function. But they no longer have an obligation to make markets. Their only obligation is to make money. So when you get some of these short-term interim disruptions, instead of placing the bid in the markets, they decide, oh, they'll short the same names. And so they'll, the hour-to-hour volatility actually climbs. It doesn't climb, and when you look at the volatility numbers at the end of the day, it's not always that visible. But when you look at the situation during the day, it certainly is. So it goes within the band, and so far has really not been a problem. But it could be. And I don't think anybody fully understands this whole thing, but when I visit with people I know, have known for a long time, in that function, and when they explain it to me, they say, Dan, don't sweat it, we've got it all covered, our book is absolutely flat. Okay, that's good. Really, really flat. Really, really flat. You mean zero? No. It's there, but we're 100% hedged. Well, that's good. How are you doing that? Well, it's all derivatives. Oh, but not to worry. It's flat. Flat can be put into another case, like their P&L, if it doesn't work. But you worry about that stuff. Most of the time it doesn't, and the newspapers are full of you ought to worry about this, that, or the other thing. In general, it's working now. How will it work? And this is, well, up here at the top of my list. How will it work if some of the international markets stop functioning well? I think a lot about our Asian business in this regard. Now, we're not exposed that way, and our client book is by and large not people you're going to worry about. They're not middle of the market people. But you don't really understand some of these things. And if that's a little thing in my mind, I think it's a very big thing in the Fed's mind. And I can talk specifically to the Bank of Boston, because the Federal Reserve Bank of Boston, because they have responsibility for the mutual funds. And I visit with those folks. Go over there, and by the way, if they invite you for lunch, accept, they've got a great chef. And they keep tabs, and they're constantly asking. They never tell you a thing, but they constantly ask. One of them will shoot me an email. Let's have coffee at Starbucks. Okay. It's not exactly a formal meeting. I offered to buy. No, they can't do that. Nor can they let me buy. So everybody buys their own. And we sit up in the atrium of our building. And we just talk markets for a while. And whatever, just whatever. They do this. This is their MO. And that's good. So far, I've left you with confusion or saying, well, when does the real speech come? The real speech is this. We're running the money day to day. We're running it primarily based on what we know about the markets right now, and obviously what our clients' objectives and goals are. In the case of a mutual fund, what the prospectus says, what the trustees say, and what many people who invest in the Loomis Sayles Bond Fund, who ride the 701 in the morning, say. along with Rosemary's Aunt Kathy, who is still going and is a retired auditor. Oh boy, she's a tough audience. The situation isn't good. The mechanics of the market are okay. The economy in the U.S. is good. Some worries now because of the tariffs, but it's fundamentally solid. And a lot of the things that you look for are clearly present. And last fall, I was giving a CFA speech where I thought that the rates were headed on up. That was in September. I did feel that way until the Fed started to change their pattern and until this situation with China started to really accelerate. And it's now to the point where you're saying, well, okay, where's the hope in all this? Where's the positive outcome? The hope, and with a lot of people campaigning for it now, much harder than they were, as the awareness of the need to cooperate around the world to deal with the climate situation is becoming more and more apparent. We can deal with it individually, individual nations, that all helps. But some of it's going to require worldwide cooperation. And that's going to take getting people to agree, even where they don't agree. In the case of the US and China, very different governmental systems. And a lot of emotions and reality in that. But you look for the middle road. Now, this part of the speech, by the way, is not popular, and I've had people get upset with me. My own view here is from an investment viewpoint, not any other viewpoint. From an investment viewpoint, it will be better, and we'll be ready to move on this, if you can start to see these avenues of cooperation build between the emerging power and the established power, between China and the US. If that can happen, a lot of the other things fall in line. Is that going to happen? I don't know. The developments right now, the winner of this sort of thing is whoever has the most allies. And neither side is doing well on that. There is a chance, and I think the chance is emerging because the stress is rising. So in managing a portfolio, I think we have to be ready for, in effect, oh my God, peace is breaking up. That's the hope. That's the hope. And as my wife has pointed out to me, she said, oh, Dan, there you go again. You're hoping. Well, it worked with teenage boys, I'll tell you. You hope for this. Now, hope is not an investment strategy. So right now, I think the strategy that we're following is correct with the Loomis Sayles Bond Fund. We're about as defensive as we've ever been. Certainly within the last 6 months, we've gotten that way. In terms of maturity, in terms of caution on credit, in terms of liquidity. You can still do all right, not sensational, but you can still, wind up in the top decile or something like that, which is a silly number. The best managers go from the top to the bottom and back and forth and average out near the top because they're not too sensitive to the market, and the market swings. But that's the view. And throughout this, and there's so much caution in the market. So my hope, not a forecast, but I think at the end of the day, the sun, just like right now, gradually breaks through the fog because the reality of this conflict spreading is too awful to imagine, quite frankly, because you don't get to solve the problem of the change that envelops us all. So you have to do something, and people are aware of that. Not everybody, but most. So there's a possibility, and the possibility is growing, which is not going to be sensational for bonds. There'll be the equity side, stocks for those who must. well, there it is. I think that's it. But right now, there's this fear, this lack of trust, this uncertainty. So for the conclusion, I'd like to tell a story. The story is this. Our two youngest sons, Tom and Dan, a few decades ago, were altar boys. These angelic little people who are up on the altar on Sundays, you know, part of the service, and everybody thinks, aren't they angels? And you're saying to yourself, if they only knew. After Mass, they're down in the changing room. One pushed the other pushed back. I don't know the exact details, and the next thing you know, they're rolling and fighting on the floor of the changing room, and Sister Julie comes along. Sister Julie's the president or the principal of the grade school. She's horrified. She takes each boy by the ear and marches them over to see the Monsignor. Sets them down in the outer office, goes in and tells the Monsignor what happened. And he says, those two, and he's laughing away. And Sister Julie loses it. She goes, gosh darn it, Monsignor, these boys are on their way to a bad outcome, and you have to do something about it. So he says, all right, calm down, sister, all right. Send in Tommy. He's the mischief maker. So Tommy goes in, and he sits down in the chair, and the Monsignor says, Tommy, where is God? Tommy just sits there. He doesn't move. Monsignor says, Thomas, where is God? Tommy sits up straight, holds each side of the chair, doesn't say a word. Monsignor says, Thomas Russell Fuss, where is God? Tommy bolts out of the chair, runs out the door, and he hollers, Danny, run for it. They're racing up the street, and Danny catches up, and he said, Tommy, what's the problem? Tommy says, God is missing, and they think we did it. One of the gods, the market has a lot of different gods. Trust, confidence is the God that's missing from the market. When it returns, I'll give you a much better outlook. And thank you very much for listening. I don't know the protocol on a couple of questions, and the bar is still open, so not too many. Okay, we'll start right here.
Hi, thank you very much. My concern is the proxy war, not necessarily that just seems to be spiraling more out of control.
It is.
Than, that maybe everybody else is just using all of these other participants because they know head on would be too much. So
Yeah.
How do you factor that?
Well, that's probably the biggest single surprise upset that could really drive this thing is exactly in that area. And so when you talk with the State Department people, that's what they bring up. You could have, it could actually be, hopefully won't be, but North Korea, South Korea, I think. That could be, or some of the other upsets. Abutting one of those is in Venezuela. That doesn't seem to involve China at all. And in Asia, you wouldn't look for anything major in Thailand because they shipped either way. That works. But the rest of the borders you have to look out for. Any one of these little things that involves, say, China and India, could trigger a reaction somewhere. But the ones that are direct proxy, the last few days you've had these statements coming out from China. It's not safe for Chinese citizens to come to the U.S. I am aware of companies that are bringing people back from China. who they feel might be unduly exposed because of their ethnic background. There are things like that. So any one of these things, looking back in history, contrary to popular opinion, I was not present prior to World War I. My father was, but I was not. But, Sarajevo, the accident there, I mean, things like that. Now that was building up a head of steam, and that was just the spark. That sort of stuff, you say, well, that's the kind of thing we have to work together to avoid. In this particular situation, insofar as the markets go and the rest, what you have to do is get the two protagonists together and say, how do we cooperate on, what can we cooperate on? And see if that can't be enough to build harmony, to deal with the things you need to cooperate on to solve the major problems. Now, that is not a popular thing to say in Wellesley, Massachusetts, in certain groups. Nor is it a popular thing to say, oh, well, let's just launch the missiles. You have to learn to cooperate, and that's so hard to do. It's a worthy goal, I've been told. So, yes, sir.
The triple B corporate segment of the corporate debt market, can you talk a little bit about that? Is the concern overhyped, or is it a real issue that might?
Well, it's obvious if we have an economic downturn, there'll be now more downgrades into double B range. And some below that. I don't take it as seriously, however, because a lot of the move down the credit spectrum on the ratings is intentional, and in many cases, is well reported. In many cases, it's optional. So you're borrowing money and you're also buying in stock, or you're doing something else. Now, if you're borrowing more and more money and investing it in a productive way, if you're in an area that allows for that, that's good. In a few cases that I know, well, no, they're borrowing more money, but I doubt the feasibility of why they're investing where they're investing. It seems to me that being the number 4 market share in some of these markets is not a smart idea. So you have to look at each one, but in general, it's been a financial decision. Where it's there because they have an unusual growth opportunity, that's another matter. So I don't take it all that, but you will have more downgrades to high yield. Yes, sir.
What do you think about the long-term prospects, not the short-term, medium term, but what do you think about the long-term prospects of a currency such as the euro, the American dollar, the Canadian dollar, the Mexican peso? Something like the Euro.
My thought, let me go back to last fall. At that point, I thought the flow of money was very clearly towards North America, the flow of incremental investment in the supply chain, principally to Mexico. That has been the case. The currencies I worried about and left all of them behind were in Southeast Asia. Now, the second strongest, a week ago, the second strongest currency in the world happened to be the Thai baht, but the others were weak, because I thought they were being pulled into that uncertain range. I'm not a great currency forecaster. Let me just, you get surprised all the time. And I thought the other beneficiary here was Canada. 2 others that were in a really good situation, the geopolitics are now threatening, despite strong country balance sheets. Australia and New Zealand are gradually being subsumed by trade patterns and cutoffs, both, into Chinese orbit. And that is not a popular thing to say to visitors from Australia, but they acknowledge it. Their trade patterns are starting to dominate. And and with New Zealand, the same thing, with the caveat that they're worried about changing the pollution controls, and can't have as many cattle to produce milk. So you have a mix of things, but they're very clearly falling into that orbit. Whether or not they will be there is another matter. That, you know, they can resist that. So it's economic pressure. As to Europe, I don't know how it's going to work out with the euro. I really don't. I hope that I feel bad for the people in the UK and England. You know, Brexit's going to do a lot of damage. Already has. Talk to Ford, the $1 billion write-off. I mean, that's a lot of jobs going away in the Midlands where you need them. That sort of stuff. So I think the North American currencies are very good. Despite the financials, I would say that, and we still have them, Australian dollar pay, New Zealand dollar pay, great financials, a lot of good reasons to like it. Some worries about the climate change for Australia now, that's becoming apparent. But they're gradually being, their point of reference, if current trends continue, their reserve currency growing will be Chinese, not US. So that pretty much covers it. There are many more individual, but North America looks good. Yes, sir?
What are your current overweights, overweights relative to your benchmark on a country, credit, and duration basis?
Oh, okay, well, the principal benchmark that's enforced on one overweight is my wife's benchmark for me, and that's overweight. Her benchmark is not. My rating is over that. So.
You look great, by the way.
Really? Well, I know a good optician already. Thank you. Well, the dollar is. The U.S. dollar right now for the bond fund. Bond fund and strategic income are the two that have a mandate that pushes in or allows more currency. Bond funds, 80% in the U.S. dollar. And you toss in Canada and Mexico, and we're 91%. And the other 9% is scattered around. And except none in Southeast Asia. And so it's Australia and New Zealand, but that's it over there. One holding payable in euro. And so that is technically an underweight because we're allowed 40. So we're half the allowance. There isn't a guideline per se. Credit in the bond fund, the optimum is viewed as BBB minus or Baa3. We're at Baa1, BBB plus. We would be, if U.S. Treasury debt was rated investment grade by both, we would be at single A minus. Interesting. One of the anomalies. On maturity, we normally run around 13 years. We're at 5 and a fraction. The liquidity reserve, same day liquidity without market impact. For the bond funds, 25%. With 1 day settlement, it's at 38%. And one of the trustees did ask, and he said, "Hey, Dan, did you retire without telling us?" And I said, "No." So far that's worked. Probably should have gone the max in single B and something like that until last week. But it is one of those times. Now let's just assume, here's my argument to the trustees when they bring this thing up. I say, yeah, good points, good points. Now the reality of life is that that money will gradually get spent on individual items that are being mispriced for the moment on a single offering in a market that's very efficient, as long as it isn't, it's within the normal bound. They'll be one by one. Well, which ones? I don't know. This bothers them a little. But I can tell you in advance, it's going to come from an area probably more around the periphery. It's not going to come from Verizon, for example. It's going to come from Beezy Weezy Widget, which might be a triple B plus, might be a single A. Nobody cares because they only have one issue outstanding. It may come from something else. No Buster converts yet. Oh, one or two here and there, but not meaningful. It'll just be one by one. Well, what's the theme? The theme is who knows. I don't recommend it as a way to reassure trustees. But that's the sort of situation that we're in right now. That's the situation. And you've been a very patient group. It looks like the bar might possibly still be open for those who must, which includes me, by the way. I thank you very, very much for asking.